What does the bill mean for investment and transaction advisory?
Investors care about certainty, cash flow, and exit tax. So the bill has provisions affecting indirect taxes, transfers, REITs, non-resident income, and restructuring. Where the tax costs rise or uncertainty increases, then investors price that into the deal. So if a buyer sees unresolved withholding tax exposure, uncertain VAT recovery, or possible capital gains tax exposure or on the indirect transfers, they either reduce the purchase price or demand indemnities or walk away. So what this means for business owners is that tax housekeeping and good tax housekeeping increases valuation. From a CFO as a service standpoint, many founder-led and mid-market businesses that engage us ahead of a transaction or a fundraise are surprised by the volume of tax exposure they have accumulated over the years. And it happens silently. Just simple gaps in processes, something not filed on time, misclassified expenditure, they quietly creep in. So there's no fraud, no intent, it's just simply gaps in process. So the Finance Bill 2026 raises the stakes even further.
Correct.
Now it's even more important to make sure you've got good housekeeping and you look at your exposure early on, especially if you're planning a transaction within 12 to 24 months. It's good to get in a CFO-led expert investigation into where do all your taxes stand and make sure that all exposures are taken care of. And with the Finance Bill 2026 coming in, things like software payments, VAT treatment on those, and indirect transfers is even more important.
Thank you so much, Deepa. That is such great insights, especially from a CFO perspective. Maybe to go over to Sajan, let's put numbers to what Deepa has mentioned. So over to you.
Yeah, sure. So, I mean, when you look at a tax change, it has an impact on valuation, especially through cash flows and risk. When we look at it from that perspective, remember, let's take an example of a 50 million shilling impact from a tax change. That 50 million, when a business is valued, especially based on earnings, which generally is a rule of thumb, it does impact the valuation multiple times, not just that 150 million exposure. So what does this mean, basically? It's important for investors to put the finance bill analysis into their valuation models to see that impact and what they could possibly offer from a purchase price perspective.